Let's go.
Our next panel, the future of tech-enabled real estate, is composed of some of the top CEOs and founders of these companies. Did you guys know that you were the top? And we are going to have, as our panel moderator this morning, the CIO of CREtech. He oversees all market research and intelligence initiatives for the largest media platform in commercial real estate. Please welcome to the stage all of our panelists and our moderator, Zandieh? Okay, Zandieh, sorry. Was that even close?
Are we on? Good. Good morning, everybody. My name is Zandieh. I'm really excited to be here today. We have an amazing, amazing panel for you guys. Year to date, we have $20 billion invested in our industry. We are at the stage of real estate tech where it's starting to actually rival fintech. And our industry is exploding with innovation, not just so much in software and hardware, but also built world innovation. And we're starting to see it in construction, commercial, residential, and so on and so forth, especially in hospitality as well. One of my favorite segments in the industry is multifamily. And being in Atlanta, you're seeing all this innovation, mass urbanization. We're really just across the street from one of the largest multifamily developments in Atlanta. And you cannot talk about multifamily innovation without talking about all the amazing startups that are in our industry. I'm really excited to be here. We have an amazing panel to talk about the new age of tech-enabled real estate. We want to kind of dive into our kind of Q&A early because I think context matters. So I really kind of want to field everyone's questions for the audience. Just quick show of hands. Who here is in conventional real estate? So not tech. Who's in conventional real estate? We got 1, 2. Don't be shy. Hi, how you doing? 3, great. And who here is in tech? Great. So software, venture, great, cool. All right. So now we've contextualized. So we have an amazing panel. I'll start from last to front. My twin suit brother, Mark Smukler, the CEO of Bixby. He's now the head of product at Hello Alfred. Welcome. Chris Bledsoe, CEO of Ollie, and Emir Dukic, the CEO of Rabbu. Guys, let's kind of just quickly dive into this. We're seeing all these trends, all these amazing trends in multifamily, and a lot of macro urbanization happening in major urban hubs. What's leading it? And I'll start with you.
Yeah, so I'm with Rabbu, Emir Dukic. We do basically automation and investment management for short-term rentals. So what we've seen quite a bit is multifamily developers are starting to get into the short-term rental space. So we work with them early on during the design build phase to help them set those properties up through automation so that operationally they're sound. Things like IoT devices, connected homes, things of that nature that allow us to create a digital footprint for hospitality by giving guests and travelers a consistent experience.
Awesome. Chris.
Hey everyone, I'm Chris Bledsoe from Ollie. For those who don't know, Ollie is a co-living operator. When we talk about co-living, I think the cleanest way to define it is, and the most memorable, is to talk about the 4 co's of co-living. So when a consumer shows up at an Ollie building, they're getting cost savings, convenience, comfort, and community. We deliver our platform through really a complete sort of ecosystem of tech-enabled services. Everything from the leasing process, which is automated, to the RSVPing to social events, to the management of things like work orders, maintenance requests, those sorts of things. Even there's a digital do not disturb button that we have in our app. So we're really automating the management process as well, and we're providing the service component on top of that, and we're putting it all under a brand called Ollie that's delivering the cost savings, convenience, comfort, and community for our consumers. I think the thing that's really driving the urbanization trend in the first place is this desire to be closer to our jobs, closer to where we can make a living, but also the desire to be closer to one another. Yet it's a little bit paradoxical because in the existing multifamily space, they can be often, as dense as they are, can be quite lonely places to live. You can go years without actually knowing even your neighbor's name. And so that's the dynamic that we're looking to change at Ollie and really reconnect people back to why they're urbanizing in the first place.
Awesome. Mark?
Yeah,
Let me just reframe the question. So what are some of the trends that are shaping our industry? And start with your company.
Yeah, sure. Good morning, everyone. My name is Mark Smukler. I was the co-founder and CEO at Bixby. Recently sold our company to Hello Alfred, where I oversee product development. At Bixby, we built technology that helped empower owners and operators to provide a better resident experience. At Hello Alfred, we're building a human-powered concierge platform that helps support owners and operators also in providing a better resident experience. I think what we always talk about in terms of urbanization, besides just the migration to cities that has continued, and it's funny how it's kind of switched over the last 5 to 10 years. There's kind of this suburbanization and people moving out of cities, but now more cyclically it's kind of come back in the other direction. But we always see the trend driven kind of by two sides, both the owner-operator side and the tenant-resident side, meaning more discerning tenants and residents, a different expectation for quality of living, different standards. And you almost, renting an apartment isn't just 4 walls and a bedroom and a kitchen today. And that's why you have more non-traditional owners and operators like Ollie and Rabbu coming to market. And at Bixby and Alfred, we always look at how do we help support traditional owners and operators in providing that same kind of experience that teams like Chris are rethinking. But at the same time, we also see that on the owner and operator side, there's finally a concerted effort to adopt technology to provide a better experience. And so you kind of have both those tailwinds, the tenants demanding more, and then a younger group of owners and operators starting to come to the table who have a different relationship with technology and are able to use it to deliver a better experience. And that's kind of what we're seeing from our side.
I kind of want to follow up with that. We were kind of joking before outside, talking about the tenant experience, and with tenant experience, with owner operators, like we can build the amazing technology, we can connect people, we can do amazing things, but without having a direct correlation to ROI, it's hard for owner operators to actually kind of grasp what that actually means, right? So we're going to talk about connectivity, we're going to talk about connections, meaningful connections, but what great impact are we seeing on the owner operator side? Like, how are we deriving? What are the cost derivatives there? What are we doing as tech companies to actually increase the ROI of the asset? Are we decreasing expenses? Like, what is that? I'll start with you, Chris, because you've done some amazing work there.
Yeah, so Ollie's model is, and tying back to that first that I mentioned, cost savings, the way that we deliver cost savings is through densification. So we're densifying the asset, we're removing square footage per occupant. And there's 2 ways for us to do that. One is shrink the size of a studio down from, say, instead of 500 square feet down to 300 square feet. Another way for us to do that is add bedrooms into an existing, say, like if it was a 700 square foot 1-bedroom, for us that's going to be a 3-bedroom. And then we use all sorts of techniques, transforming furniture and all that to make it a lot more comfortable and palatable and a place that's desirable for the consumer. Now, the reason why, this is a little bit of a roundabout answer to Asher's question, but the reason why densification is important is not just because it delivers cost savings to the consumer, but also because it unlocks a real estate arbitrage. So Ollie's business model, we're monetizing essentially our trade with the consumer for space. So the deal is, give us space back, we're going to reallocate that to another unit that we can rent out or another bedroom that we can rent out. And we're going to give you lifestyle. But we're so efficient at eliminating space from the consumer without them missing it that we're able to generate even more revenue for a building than a conventional apartment. So our most recent location, about 422 beds in Long Island City, That location
In New York.
that location has created a really great case study for what we can do for the owner of an asset economically, because the upper 2/3 of that building are conventional apartments and the lower third are Ollie densified units. We've unlocked about a 50% revenue per square foot arbitrage, which net of all of the costs involved in delivering on the Ollie brand experience, Wi-Fi, cable, housekeeping, social events, and the list goes on, net of all of those costs is translating to over a 1/3 improvement in the NOI. Now, our model is driven mostly by unlocking this arbitrage, and we've created this machine essentially in a brand to help us do that at scale. But there's also a little bit of a service margin. The fact that we're buying Wi-Fi in bulk or furniture in bulk or housekeeping in bulk allows us to negotiate economies of scale kind of pricing, and then either pass that through to the consumer in the form of a lower price point or capture margin for our own business, or a little bit of both.
Amir, I see you nodding your head.
Yeah, no, I mean, I agree with everything Chris said. We started Rabbu initially as a basically operator of short-term rentals based in Charlotte, North Carolina. What we found with the growth of Airbnb, hospitality-wise, travelers were looking for full homes to stay in, not just in traditional vacation destinations like beaches or resorts or mountain cities. They were looking to do so in urban areas, and that's how we started. We started offering single-family homes initially in Charlotte, North Carolina, and then started partnering with multifamily developers who saw some of the upside as well. They saw travelers are looking for full-service homes to stay in as opposed to in hotels. So by working with these owner-operators and converting long-term apartments and long-term multifamily residences into short-term hospitality operations, they've been able to generate a significantly higher return on their homes, usually it's over 60% as opposed to what they would be able to generate off traditional long-term. So it's been a great way for them to use the short-term rental strategy as an investment opportunity to generate more revenue off their properties.
Now, do you guys focus on single-family homes, or is it multifamily?
We do, so from our automation platform, we do both, but a lot of our growth recently has come with multifamily, with owner-operators and developers during the design-build phase from the get-go. More and more of the forward-thinking operators are starting to utilize their entire portfolio as short-term rentals, so we work with them from the get-go.
That's awesome. And so, Mark, you come in from a really interesting point because you're actually servicing these assets. Like, walk us through that. What does that look like?
Yeah, I think the conversation in terms of ROI is very different from my side of things. Obviously, densifying the unit, I mean, there's clear arbitrage there. For us, we always talk about operational efficiencies. The statistic we point to is if you're a property manager who can utilize the technology to better communicate with residents, more accurately and efficiently capture rents, and most importantly, more efficiently process maintenance requests, which is the largest contributor to your operating expense, that's where the ROI comes from. And we often say that a property manager on a platform like Bixby can manage about 300 units versus a property manager without a product like Bixby can oversee about 100 units. And so if you're thinking about it from the property manager side of things and their business in growing their footprint, every new building that they win a management agreement for, they need to hire a full staff. So products like ours make their business more scalable. Yeah. On the Hello Alfred side, it's a little bit different. It probably comes in from the side of the amenities arm race. And unfortunately, it's probably a little bit less of a question of ROI and more differentiating the building, providing services that other buildings in your area don't, and retaining tenants. And that's probably where the ROI really comes from. Because I think the statistic is every turnover contributes to about $3,000 of operating expense. So for every 10% that you can limit turnover, there's significant cost savings there. And what can you do to give somebody just a little bit of a better experience in the building so that they choose to stay in you versus going to another building nearby?
That's a great point. I remember growing up in the multifamily world, the number one thing that ate at your income was always a vacancy. One vacancy wiped out your entire profit for that one unit that year that you always hoped that actually that tenant would renew. So speaking about all this amazing stuff you guys are working on, accessibility, you're talking about transparency, you're talking about bringing people together, densifying in a smaller space. what we're starting to really talk about is, you know, transparency in our industry, both in terms of on the tech side, but also on the living side. Walk us through, and this is not just for us. This is like has been an emerging trend for the past 5-10 years. Walk us through what that actually means. What is transparency, and why is it so important? You know, like, we're so willing to, like, push a button when we sign up for Facebook or IG or whatever. We're so willing to give up our information and our privacy, but yet when it comes to living, we're a little bit more guarded. But when you give up more information, you get better service. Walk us through what that actually means in our industry. Amir, I'll start with you.
Yeah, I mean, in our space, with short-term rental specifically, where we've seen most of our successes, people are willing to open themselves up to new experiences in you know, non-traditional accommodation spaces. Anytime we work with a client, we tell them to be transparent with their entire community, to let them know, okay, this is going to be a short-term rental asset. We're going to do X, Y, and Z with it, so that, one, it sets the proper example for all the tenants that are already in the space and that are in the neighborhood, but then also creates less friction when a tenant, when a guest, hospitality traveler shows up. We've seen quite a bit of Airbnb, you know, horror stories of, you know, apartments or residences being illegally rented on Airbnb or at least arbitraged. So we encourage our clients to be as transparent as possible with the community.
I mean, I can think of a lot of examples where it's just going to be a lot more advantageous to be transparent, whether that's with, you know, whatever your amenity build-out schedule is, or with whatever information you're collecting from the consumer and what you're doing with it and how you're storing it. Transparency is a plus across the board, but I would say there's heightened sensitivity. If you think about housing as a consumer product category, and I do think of it that way, although that's, I know, kind of not the norm, but if you do think about housing as a consumer product category, I think it's the most intimate of consumer product categories. Some products, you know, are tactile and you have a sort of external relationship with the product, you know, like household goods maybe. Something like food is intimate to the next level because it's something that you're ingesting, you know, into your body. And then I think housing, you're physically putting yourself into, you know, into this space, and you know, this space has, you know, holds your private, most intimate moments. And so that, I think as a consumer product spectrum, in terms of intimacy spectrum, I think housing is as intimate as it gets. And for that reason, transparency is really the ultimate thing that we owe our consumer who's trusting us with that level of intimacy.
You know, to that point, like, you see what Amazon's doing. They don't want to actually build homes. What they really want to do is deliver your packages and your goods to your home and place it inside your refrigerator. You know, when we're talking about, you know, transparency, are we really talking about, like, what are we giving up? Like, you know what I mean? Like, what are we actually giving up? Like, can you walk us through, do we have to compromise ourselves in order to achieve the utopia? You know what I mean? Or, like, what do we have to do for us? Like, you see it in China, right? Like, in China, you give up all your rights and they're super efficient, but in Europe, the complete opposite. They're so data guarded. And so you're seeing less and less you know, emerging real estate tech companies in Europe because of that, and they're actually coming to the US or going to China. So the talent's coming here anyway. Like, but walk us through what that actually means. I don't think people, like, the people that we talk to, they don't seem to actually really understand the impact of what transparency actually means. What does that mean when it comes to living?
From my point of view, it's the building block of trust, and to have any transaction that's not built on trust is a recipe for disaster, or at the most, just a one-off transaction. And what we're trying to do is create longevity, create renewals in leases. What we're asking the consumer to do is hand over information, and information, when it involves intimate aspects of one's life, information can be used against you. And the trust building that has to occur And even this goes down to the heart of why we named our company Ollie. We wanted to humanize, anthropomorphize the experience. The idea is that Ollie is everybody's favorite neighbor, everybody's favorite roommate, the roommate that's picking up, after the mess that was created or organizing the social events. We wanted to humanize that aspect for the consumer, for this transaction to be built on a foundation of trust. Because without that, that consumer is not going to be okay with that, with that camera in the hallway, or the listening device in the common space, or the tracking, and increasingly to be able to service the consumer in a cost-effective, in an effective way, but also a cost-effective way. We need the consumer to be willing to transact with us on that basis, with volunteer their information to us.
So speaking of trust, Mark, you're actually going into their units. Like walk us through like the logistics of that. Like, what does that actually look like?
Yeah, so for those of you who are less familiar with Hello Alfred's service, the core full-service offering from Hello Alfred is providing an Alfred to every unit of the building. And that's an individual who becomes the equivalent of your butler, but we really don't like looking at it that way. More like your trusted advisor for your home, with the end goal of making your home a place that is truly comfortable and convenient for you. So the 4 core services that an Alfred provides are a weekly tidy up. They go into your room or into your apartment. They'll make your bed, they fold your clothes, they take out your trash, they do a surface cleaning, and they leave in about 30 minutes. They'll also pick up and do your dry cleaning and your laundry. They will also do your grocery delivery. And they'll also deliver your packages into the unit. So to Chris's point, to Ash's point, in order for the consumer to get comfortable with an individual doing that on a weekly basis when you're not home, it's all about building trust, and we talk about it all the time. It takes a lot to get there, and it's why I think building an organization in the space that Hello Alfred did, in the space that both the individuals here do, is such a challenge.
Yeah, and it's been a unique experience for us as well on the hospitality side. So when we first started building out our automation platform, we started doing this about a year and a half ago, and this is where smart speakers were all the rage. So we started building out automations with Alexa, where guests could ask Alexa certain questions, and what's their favorite restaurant to go to. That was the idea. We were really excited about it. Turns out that about 70% of guests that stayed at a unit that had an Alexa in the unit disconnected it. They just unplugged it. They were afraid of potentially being monitored. They didn't have trust in it. So we no longer offer that service. But the service that they do trust and believe in is we collect the last 4 digits of their phone number, and that's the code that we set to be their access code into the property. Wherever they stay at a property that's managed by our platform, they have the same access code. And that only works from the minute their check-in is supposed to start to the minute checkout is. And that's been a huge positive that we've seen across the board because we created trust. We've had operators ask us to do cameras and automate cameras inside properties, and that's a big no for us because it violates the trust and privacy. So, yeah.
That's awesome. I'm going to quickly switch the conversation here. Seeing that a few people here, actually a lot of people here are in tech. In our world, we talk about scalability and the path to scalability. When it comes to that, you guys all sit in different amazing seats, from hospitalities to living to services. What is the perceived scalability of your industry? We see, not to name drop or kind of talk about a certain commercial co-working company that's trying maybe or maybe not trying to go public, joke. What is, and if anyone read the S1, that was crazy, it was nuts. Let's talk about it. What is the perceived scalability in each of your verticals? I'll start with you.
Yeah, I mean, in the hospitality space, Airbnb was our initial market, and the whole key of Airbnb is that you have unique spaces wherever you go, and that makes scalability difficult because every house has unique characteristics to it. And the way we solved that problem was through smart home and IoT devices that allow us to automate access, energy consumption, and honestly, Wi-Fi monitoring. And what I mean by Wi-Fi monitoring, Wi-Fi is the #1 amenity that travelers look for, because who can work or stay anywhere with no Wi-Fi? So we monitor Wi-Fi in the sense of, is it up and running? If it's not, we reset it, things of that nature. So it's just starting to create a standardization in around those things. That was the first step for us. And now it's in the scalability through density within a building to be able to do that at scale.
Chris?
Yeah, I think Ollie's own founding story speaks to what the scalability challenges are with our industry, with co-living. The fact that we had to take, my brother and I, when we started Ollie, we left our jobs in 2011. We thought we were off to the races because we had just obtained a Department of Buildings approval on how to densify a building code compliantly. But it turns out we had to take 400 meetings over the next 3 years just to get to our first yes. And it turns out that, then regulations were not the bottleneck for scaling. The bottleneck for scaling was the conservatism of the capital that are the gatekeepers to the multifamily housing industry. That conservatism of the capital creates aversion to change. People are, if you're investing in the multifamily, apartment sector, you're particularly in these gateway markets, you're investing in the most conservative sector of real estate, the least cyclical, most acyclical, and you're investing in a category that's got 95% plus occupancy rates. And if you're a lender in this sector in particular, you're comparing your returns against government bond yields. So risk aversion is what any tech platform or service platform in the multifamily space has to overcome. And that's about building trust, not with the consumer, but with the investor. And so I always think about Ollie, we serve two masters, and I feel like we've really got our consumer product down, but the much longer process has been building trust with the investor community. And the reason why we took 400 meetings before we got our first yes, it's not because people were saying, you guys are, this is a crazy idea, this will never work. Everyone was telling us, we want to do your second building. So we had to build that trust. And the best way to build that trust is to find somebody who will pioneer with you, incentivize them to be that pioneer with you, and create that template that prototype and template that you can point to. You can't. It's at least for Ollie, we had to do that. We couldn't just put an app out into the world and then iterate on that app. We needed to put an app into a building, and people, and a program, and a brand on a building in order to get our model out there. That building that we got our first yes on, that we left our jobs in 2011, got our first yes in 2014. It only opened up last year, 2018. So it's a long process. But the good news, I think, is that there's an inevitability to what all of us on the stage and other prop tech players are doing. There's a certain inevitability to the automation of the home and the hospitality engagement and the community engagement in the home. There's an inevitability to all of this. So the end game is that you're disrupting the single biggest consumer product sector in the world, housing, and the question on scalability is not if, it's when. What is the timeline that this disruption is going to occur over? And that will dictate the IRRs for any venture group investing in this space.
Mark?
Yeah, I mean, I certainly agree with Chris that the trends that we're following and the operations that we're putting in place have a certain inevitability to it. And you can think of it, we think of it as the hotelification of residential real estate, bringing in those services, both the way you capture additional monetization, you monetize the resident or the consumer in ways that you traditionally didn't before in real estate. But I think you can really look at scalability based on where you sit in the marketplace. So in terms of owning assets, your constraints there are capital. Your constraints there are regulations, Department of Buildings, construction. How quickly can you develop? How quickly can you develop in markets where you don't have expertise? I think scalability there is the most difficult. And I guess you can point to individuals like Stephen Ross at Related and the incredible business that he's built and diversified beyond traditional real estate. Beneath that, you have property management. In property management, your scalability constraints are also regional, but they're also mostly human capital. For every new building that you acquire to manage, you have to staff it up. And you're working in a very human capital intensive business where you're maintaining the asset, leasing up the asset, and those are the scalability constraints there. Below that, you have vendors and service providers. Hello Alfred probably sitting above Bixby because Hello Alfred is also a human-powered concierge business. So for every new market that Hello Alfred wants to open, they're currently in 15 markets, having grown from 4 markets 6 months ago. They need to put an office in that market with area managers, and then staff up a team of Alfreds, who are actually the individuals providing the service in the unit. Also relatively human capital intensive. And then you have technology solutions like Bixby. And frankly, this transcends just the real estate industry. In any business, a SaaS-based platform will always inevitably be more scalable than one that is human capital intensive. You can almost think about Airbnb versus WeWork. Airbnb is a true two-sided marketplace SaaS platform. WeWork is actually managing assets. Probably the top line revenues in a WeWork type business will inevitably be much larger, but the gross profit and the margins will inevitably be much smaller. With Bixby, we grew in a 3-year period to 3,000 properties and 300 units, but we did it on the back of a self-serve platform where anybody can sign up, regardless if you had one single family home or a 40,000 unit portfolio, and get up and running potentially, arguably, without ever having to speak to anybody on our team, and we were able to do it with a team of 15 people. Now, at the same time, our product cost $1 per unit per month versus Alfred's at $40 per unit per month versus the kind of contracts that these individuals are seeing. So I think it just depends which market you play in. And at the end of the day, a contract with Chris's business is going to be much larger than one with Bixby, so we have to achieve scalability in order to build the same scale of business.
Awesome. So want to kind of leave time for questions, people that might have some questions. Anyone have any questions? We did such an awesome job. Nobody has any questions. This is awesome. That's the first. You got a question in the back? Just state your name, where you're from, and who the question's for, or is it just a general panel?
Well, it's just generally Jag from New York. I wonder, how do you guys go around the rules around Airbnb in New York City with the kind of abolishing Airbnb in New York? How does that work with co-living?
So if ever hear that question, how do you get around the legal framework of Airbnbs in New York?
Yeah. So I'll take that. Thanks, Jack. So the underpinning of Ollie's business model, the number one pain point that we're looking to solve is the affordability crisis. And so our consumer, the big pain point is not that they need a new place to live every week or every month, but that they need an affordable place to live for the next 12 or 24 months. And that's what densification allows us to do. That said, because of the hotelification of our brand experience, the fact that you're coming into a furnished unit with Wi-Fi and cable set up for you, with housekeeping, bed linen changes, towel changes, bath amenities getting topped up, toilet paper getting restocked, it's like living in a hotel. And so because we've developed those organizational capabilities to manage that experience, we decided, hey, why not see if we can go the extra 10% of the way, managing a front-end process and a listing process, a check-in process, the things that, and being able to manage a nightly stay. Why don't we just go the rest of the way and actually create a shorter duration capability within Ollie? So we've done that as well. We launched that, we piloted it in our Pittsburgh location, and we call that strategy co-lodging. So there's co-living, longer duration stays, and co-lodging, shorter duration stays. Not every market is going to allow us to operate our co-lodging model, but that's okay. It's not our brand promise to the consumer that they're going to be able to have that option in every location. However, where it is super valuable to have that, and where in markets that do allow for it, the typical turn on a unit when it vacates on a 12-month lease, it takes about 1 month to refill that unit. So it's this structural vacancy that's been created in the multifamily market. At Ollie, by adding the co-lodging capability and being able to shift that unit onto Airbnb until it relets for the next 12-month lease, we've been able to take that structural vacancy from 5% down to about a half a point. And that's all incremental dollars that drops to the bottom line for the asset. New York, it's not just a function of zoning, but also if you're in a rent-stabilized building and it's collecting a tax abatement, you're also subject to a 6-month minimum or sometimes 12-month minimum duration. And so some buildings, we just can't do it.
Please state your name, where you're from, and who the question's for, please.
Yeah, it's a great question. It probably comes down to like the potential recession or any future downturn. And will owners start to scale back what they're offering, and will they need to? But I think it's probably actually more tied to the supply of buildings in a given area. And I think that we've built so much over the last 3 to 10 years that, especially in Class A luxury, where there's always going to have to be buildings that look to differentiate. They might change how they look to differentiate. I think 5 years ago it was like a top class gym in the building. And I think now all Class A buildings have a very nice gym in the building. So what's next? Is it a pool? I know a lot of people talk about building community. So companies like TF Living and Home who are doing events in the building.
Ollie?
Ollie in certainly a different way as well. So I don't think the amenities arms race is necessarily going to change in the fact that people are going to be looking to bring new services into the building and differentiate that building. And what I'm actually really excited for are like branded buildings, right? Buildings that are built for a specific community or a specific person, and everything in that building is geared towards that, from the programming to the amenity space to the apartments themselves. I think we're going to start to see that a little bit more, and I wouldn't be surprised if companies like Ollie are the ones who are driving that, because of the expertise that they've built in working with buildings at an operational level. So no, I think we're going to be okay there. I think buildings are going to keep getting better.
Yeah, a couple things I'd add. So as I mentioned before, we're based in Charlotte, North Carolina, and there's a boom of apartment buildings being built everywhere. The city's growing amazingly, and there's startups in town with the sole focus of doing exactly what you mentioned. There's a startup in town that provides doggy daycare and dog walking as an amenity. Another does laundry, pickup, delivery. What we've also seen from some of the operators we work with is them allowing their tenants to rent their spaces on Airbnb for a percentage of the time that they're there. So usually around 25% of the time they're allowed to rent those spaces out as Airbnbs as another amenity. So it's really interesting.
I think one of the dynamics that's really also interesting, and building on Mark's comment as well, is you think about the amenities as physical spaces, and you think about the gym as being the most popular. Typically, I mean, we see about 20% engagement among our residents in the fitness center. Now, what percent come into the building thinking that they're going to use it is probably a lot higher than 20%, but we see about 20% actually using it. If we look at the community events that we organize, we see our residents attending at least, we see 44% of our residents attending at least one event per month. And so that makes the events that we organize by a factor of 2x or more. It makes the events that we organize by far the most popular amenity. And the nice thing about events is we don't have to organize those, and we don't limit it to the building itself. We can turn the entire neighborhood, the entire city, or even outside of the city. We do day trips to organic farm tours, and we did a ski shoeing and a whiskey tasting, in that order. But we do these events, and they seem to be far more popular than the even more costly amenity spaces that some of the buildings are creating for themselves.
Do you think that due to the loneliness epidemic that urban cores are now starting to face, like in New York specifically, we've experienced that Google has been working really hard to address that with their staff. As cities become more and more urbanized, this whole lonely, I think IKEA even did a study on this, on the loneliness epidemic. Do you think that's, people are naturally trying to find their place in the world through peer groups? And that's why it's leading to more of those amenities being served?
Yeah, I guess
everyone.
There's this company called Facebook that kind of tried to address that, and so yeah, I think there is a loneliness thing, and people are looking for peer groups.
It's super ironic too that we're living in the most digitally connected time, and we're more urbanized as a society than we've ever been before, and we're at amongst the lowest unemployment rates in history, which is also a if you look at past suicide spikes, which is an indication of loneliness, we've seen that spike in higher unemployment periods, recessionary periods. So how is it that we're facing this loneliness epidemic and suicide epidemic really in such a period? And I think that in a lot of ways, I do look at co-living as being an antidote to both of those trends. I also think that community is not one size fits all. Even though Ollie's focused on large scale communities, there's kind of sub communities within that. It's hard to have a close relationship with 400 plus people, which is how big our buildings are. So one of the tools that we use is early on is a roommate matching platform. And there's a question on our roommate matching platform, which by the way is cheekily named Bedvetter. So Bedvetter asks the question, what are your hobbies and your interests? And we haven't gone this next step yet, but it's on the roadmap for us, to Mark's point, to say, okay, you're a scuba diver, the person in unit 9B is also a scuba diver. Why don't we put the two of you together and be more of a suggestive, recommended social kind of experiential platform, as opposed to simply organizing or curating events on a more one-size-fits-all basis.
That's great.
Yeah, the only thing I'd add to that, I think we've also seen a significant increase in the people working remote. So they're, they don't have the community at work, so they're looking for opportunities to get together, whether, through co-living or through co-working or co-anything. I think that's the opportunity here.
Cool. We have time for one more question. Gentleman in the front, state your name, where you're from. Not like really where you're from, but the company you're from. I should have specified, and your social security. I'm kidding.
I'm Robert Cooper from Emir based in Boston. So a question, how much do what each of you is working on apply to secondary markets, some of these C&D class properties, garden style, which is seeing a lot of interest these days, let's say?
One of my biggest pet peeves is, I'm a real estate guy, and one of the things I hate is when people like by definition, first markets are New York and LA and Chicago. By definition, Atlanta would be a secondary market. But the economic boom we are seeing in Atlanta does not classify it as a secondary market. Same thing in Dallas, Nashville, Austin, Miami, and then throughout the entire U.S. So I think to help to frame that question, I think we have to look at and contextualize that and say, where are we seeing massive economic growth and geographical growth in terms of population density? So to that.
I'll just say that Ollie's second building that we opened was in Pittsburgh. And a lot of people told us we were nuts to go to Pittsburgh. For those who don't know, Pittsburgh is, of the top 30 MSAs in the country, Pittsburgh is the second most affordable for housing. And I said earlier, the number one pain point we're addressing is the affordable housing crisis. But regardless, at least I can speak to Ollie's model here, regardless of what market you're in, your rent check if you're a renter or mortgage payment if you're an owner, your housing cost is your number one biggest expense. And if you can provide value, if you can get that down, then that's a winning proposition to the consumer. So the consumer is ready for co-living in a lot of different markets. I'll also add that co-living is not just about cost savings, it's also about the other 3 C's: convenience, comfort, and community, and those are universal. So, the consumer is seeking those regardless of whether they're in Pittsburgh, Atlanta, New York, San Francisco. The consumer wants convenience, comfort, and community.
And I'll just add that I think we both know value-add communities and properties can be some of the best for our business because we're a low-cost way to provide better service, whether that's on the IoT side of things or the operational efficiency side of things or providing service in the unit. So as long as rents can sustain these kinds of value-add renovations and putting products like ours into the building, then absolutely it might even be a better market. And especially in terms of the amenities arm race, which might top out in the large urban dense areas, you'll start to see that slide into suburban areas and other markets like Philadelphia or like a Cambridge versus a Boston.
Yeah, and from a hospitality space as well. So we're based in Charlotte. It's a great market. One, the real estate is affordable. Two, there's lack of hospitality options from a hotel space, and there's limited regulatory issues there. Charlotte actually works with Airbnb and charges tourism tax, so it's a revenue generator for them. So we've seen most of our success in secondary markets: Charlotte, Atlanta, Jacksonville, markets like that.
Cool. Great. Done? Yeah. Done? We gotta wrap it up. All right, we're done. I'm getting the cue. Gotta go.
Thank you.